Bitcoin keeps falling, day after day, dip after dip. And if you're feeling the pain, just know you're not alone. You got caught in the mess, and so did I. Most of us did. It's brutal out there, a perfect trap where global politics, a misunderstood Fed, and some ruthless whale activity all came together to create one of the most efficient leveraged liquidations I've ever seen. Let's break down what really happened, not so we can dwell on the past, but so we can spot the next one before it spots us. This was a three-act tragedy of geopolitics, monetary policy misreads, and a brutal whale hunt, revealing that crypto path to maturity is paved with predictable and often exploitable human behaviors. Stick around to the end, and I'll show you how to navigate this chaos. Act 1. The Geopolitical Shockwave, Tariffs and the Return of Risk-Off Sentiment. On October 10, 2025, a political shockwave from Washington, D.C. slammed into global markets. President Donald Trump's announcement of a dramatic 100% tariff on Chinese goods and strict software export controls didn't just rattle traditional equities, it sent a violent tremor through the crypto world. The result was a bloodbath for Bitcoin, which plummeted to near $104,782. But the real story was the hidden carnage beneath the surface. An estimated $19 billion in leveraged crypto positions was systematically liquidated. This wasn't a simple sell-off, it was a forced deleveraging event. So why would a trade war in Beijing and Washington crash a decentralized digital asset? The answer shatters a popular myth. For all its digital gold branding, the institutional world still treats Bitcoin as the ultimate speculative bet, a high-risk beta asset. When macro fears ignite, the appetite for risk evaporates, and speculative assets are the first to be thrown overboard. October 10th was a brutal reminder that in a true crisis, correlation soars and crypto is not yet an island. But that initial crash was just Act 1. The sell-off didn't stop there. The price has been grinding lower and has now broken a critical level, sitting at $84,000 as we speak. So what happened after the initial shock? The story gets darker. Act 2. Fed cuts plus mixed messaging. The Federal Reserve made an interest rate cut, 25 basis points, at the end of October. On its face, easy monetary policy should help risk assets like Bitcoin. But the reaction was muted and, in fact, somewhat negative. Here's what happened. The Fed cut rates to 3.75 to 4.0%, but stressed that further cuts are not assured. In other words, we cut, but we're not fully committing to more. Investors had been assuming many more cuts. Once the Fed poured cold water on those expectations, risk assets faltered. For Bitcoin, that meant uncertainty. A rate cut typically boosts liquidity, weakens the USD, encourages risk-on flows, which should help Bitcoin. But if a cut is accompanied by cautious language or signals of economic weakness, the opposite effect can happen. Risk assets sold because the narrative is now recession risk rather than growth stimulus. Traders who were banking on 5 or 6 Fed rate cuts suddenly panicked. Expectations collapsed, the bond market flipped, and instead of easy liquidity, the market started pricing in tight conditions. When liquidity dries up, Bitcoin suffers first, harder, faster, because it's still the highest beta asset in the global financial system. But that's just the surface. Let's dive even deeper. Act 3. The Whale Hunt. How leverage became the fuel for a cascading crash. Right before the crash, long leverage exploded across major exchanges: Binance, Bybit, OKX. Millions of traders piled into long positions, many using 20 times, 50 times, even 100 times leverage. And then, almost perfectly, the market dropped straight into the biggest cluster of liquidation points. It didn't drift, it didn't correct, it snapped. Over $900 million in long liquidations were wiped out in less than 24 hours, like someone flipped a switch. When whales want liquidity, they take it from over-leveraged traders. In crypto, liquidation isn't collateral damage, it's a strategy. Layer on ETF flows. Just as Bitcoin fell, U.S. spot ETFs flipped from steady inflows to aggressive outflows. Large institutional players started taking profit right as retail leverage peaked. That timing wasn't a coincidence, it's a pattern. When institutions exit quietly, retail pays loudly. And there's another piece no one is talking about. Stablecoin liquidity, the lifeblood of Bitcoin bull cycles, has stalled. USDT and USDC supply barely moved, so no fresh money was entering the system. Yet Bitcoin was pumping anyway. That wasn't organic demand. That was leverage-driven pricing. And leverage-driven pricing always ends the same way, with a violent reset engineered by those profiting from it. Finally, market depth came into play. Order books across major exchanges are at 2-year lows. Liquidity is thin, so when a big player decides to shove the market, it moves. Hard. There's nothing in the book to stop it. Put it all together, and Bitcoin's strange behavior suddenly makes perfect sense. Whales attacked leverage, ETF flows flipped red, Trump's tariff threat spooked global markets, Fed rate cut hopes evaporated, liquidity disappeared, stablecoin inflows stagnated, and the perfect cluster of liquidation levels was targeted. This wasn't panic. This wasn't retail fear. This was a coordinated reset. Macro pressure at the top, whale pressure at the bottom. So, where do we go from here? If you're staying in the market, or even if you're just watching from the sidelines with curiosity, your playbook has to change. The rules of the game have been rewritten, and your attention needs to be in a few key places. First and foremost, you have to become a part-time geopolitical analyst. The days of ignoring world news are over. The October 10th tariff threat was a cannon shot across the bow, a clear sign that any new escalation, whether it's more tariffs, tech bans, or a major supply chain shock, will send a violent ripple through the crypto markets. When global tensions rise, risk appetite falls, and we now know Bitcoin is first in line to get sold. Next, you need to rewire how you listen to the Federal Reserve. Stop focusing solely on whether they cut or hike rates. Instead, listen to the story they're telling. Is the tone confident and supportive, promising more help if needed? That's fuel for a rally? Or is it cautious and worried, hinting at underlying economic weakness? That's a recipe for outflows, as we just saw. The narrative is now the real catalyst. You also need to keep a constant pulse on the market's internal health. Don't just stare at the price. Watch the real-time indicators of greed and fear, the flows into and out of crypto ETFs, the amount of leverage piling up on exchanges, and the funding rates in the futures markets. When these numbers get excessively high, it's a warning sign that the market is running on borrowed time and borrowed money, becoming dangerously fragile. Thin order books mean even a small shove can cause a massive move. It's also crucial to be honest about the story Bitcoin is telling about itself. For all the talk of digital gold, the current evidence points to it being a high-octane, speculative play. Right now, it's moving in lockstep with tech stocks and other risk assets, not against them. Until that correlation breaks, assume that if the S&P 500 has a bad week, we're probably in for one too. And of course, don't throw technical analysis out the window. Pay attention to key support levels, like the 200-day moving average. A clean break below a major technical floor can often signal that this is more than a short-term correction and could be the start of a deeper, more painful downturn. The bottom line is this: Bitcoin's strange behavior isn't really about Bitcoin itself. It's a mirror reflecting a jittery global macro environment. We have trade wars killing the mood for risk, a Fed whose attempts to help are backfiring, and a market of skittish speculators ready to bolt at the first sign of trouble. Understanding these forces is your best defense. It's the difference between being a victim of the storm and someone who sees the clouds gathering. If this breakdown helped you make sense of the chaos, make sure to hit that like button and subscribe. It genuinely helps the channel grow and helps other investors find rational analysis in a space full of noise. Thanks for watching, and I'll see you in the next one.